Friends, welcome to our today's session. We are going to learn this concept called valuation base or basis of values. This is very important for us because on that basis, we need to decide which valuation approach, which valuation method is to be followed. The valuation base and valuation premises both play a very important role in applying suitable methods and selecting appropriate approach to value a company or value the shares of a company. So going to share the screen with you right now. And as you are aware of this concept, we are learning, keeping in mind the provisions which are prescribed or which are suggested in International Valuation Standard, as well as the valuation standard which are issued by Institute of Chartered Accountants of India. So Indian standard as well as international standard, both the standards is to be taken care of. So here is a caption, you can read it. What a company is worth depends on who wants to buy it. Okay, so that means that the value may vary depending upon the situation. So this also we are aware of here, that for different persons value might be different. Okay, and with that background, let us first understand what is the meaning of basis of value or valuation base. And to understand the meaning, I need to refer to these paragraphs, paragraph 10.1, 10.2 of International Valuation Standard number 104, which talks about basis of value or valuation base. Okay, so this is exactly taken from International. So let me explain you this thing. So this basis of value, what I'm referring to, also called as the standards of value. Friends, try to understand. This finishes standards of value that are different from valuation standards. As you are aware of, valuation standards are, when we talk about valuation standards, sometimes we refer to international valuation standard. We have seen some of them. And in India, valuation standards are issued only by the Institute of Chartered Accountants of India. So we refer to that valuation standards. That means that those standards talks about a standardized process or standardized guidance through following which you need to do evaluation. That's different. But which is the standard of value means basis of value. So many times in valuation report, you can see, if you read some international valuation report, sometimes we see it is written standard of value, fair value. That means the base of value is fair. That means the value has tried to arrive at the fair. So standard of value and the base of value are the same thing. Are you getting? So when we say standards of value, what I mean is the basis of value. And standards of value and valuation standards, they are two different things. Okay. And these standards of value or this basis of value describe the fundamental premise on which the reported value will be based. That means on the basis of which we are arriving at the value that is described in this basis of value. And this is important, or it is very critical, because the appropriate base needs to be selected. Okay, it is critical that the basis or basis of value to be appropriate to the term and purpose of valuation assignment. So one need to understand what kind of valuation assignment he is having. So accordingly, he has to decide what is the appropriate base for that particular valuation assignment. And this basis may influence, or you can rather say dictate, the valuer selection of methods. If basis is different, then valuer may select a different method. Okay. Selection of methods, inputs, assumptions, and ultimately the opinion of the valuer. That means valuer's opinion is influenced by the basis of value. The methods that valuer is going to select, that is also influenced by the methods of value. The inputs that valuer is going to select also is affected by the methods of value. The assumptions are also affected. So all these things are affected by the basis of value. Okay. Are you getting me?
Yes, sir.
Sometimes what happens, the valuer may be required to use basis of value that are defined by statute, regulations, private contract, or other documents. In that case, valuer has got no choice. He has to adopt that particular method of value, the particular base of value. because it is defined in the statute or defined in the regulation, or there is a private contract and valuation has to be done according to that contract. So that contract may form as the base of value, or maybe there is some other document where the basis of value has been decided. The valuer has to adopt that particular base. Okay, so when the statute defines, a regulation defines, or a private contract or some other document defines basis of value, such basis has to be interpreted and applied accordingly. This is what is prescribed in International Valuation Standard 102. Are you getting me, or if you have any query on it? So first thing we have understood that we need to conclude or need to select the appropriate base, because that is going to influence the methods, inputs, and assumptions and opinion. Okay, but however, if the basis of value has already been defined by statute, regulation, or private contract, that has to be, that particular base has to be selected. Okay, for example, let us say if we talk about our Indian context, in certain situations, the base of value, how valuation has to be done, is defined, let us say, under Income Tax Act 1961. It's also defined in FEMA, Foreign Exchange Management Act regulations, right? And also in Insolvency Banking Professional Code, it has been defined. So in different situations, how valuation has to be done, it has already been defined. When it is defined, that has to be interpreted, and accordingly, you should do valuation on that basis. Would you like to see some example how it is defined?
Yes, sir.
Okay. So, for example, let me take you one example at least. So, I am going to take you to the Income Tax Department website just to give you some idea how a statute had defines that valuation has to be done in a particular manner. So, are you seeing this Google Chrome browser right now?
Yes.
Okay. So, let me take you to this website. Yeah, incometaxindia.gov.in. This is one of the statute, one law. Income tax purpose, sometimes we arrive at the value of shares. Okay. For the purpose of capital gain calculations or for the purpose of merger and acquisition. You can see here, this is the Income Tax Department website I have taken you. Here you see ARC's rules, I'm taking you to the rules. Okay. I'll take you a set of rules in 11U series. So now I'm going to income tax rules, you see. You see so many rules are there. So let me take you to the rule 11U. Okay. Now you see. Are you able to see? 11U. Can you read it? What is the meaning of this?
Meaning of expressions are used in determination of fair market value.
So it has been defined. What is the meaning and expression used in determination of fair market value? Now read the next rule, 11UA.
Determination of fair market value.
UAA, 11UAA.
Determination of fair market value for share other than quoted share.
Then UAB.
Determination of fair market value for inventory.
So you see, various rules are there which discusses how you need to arrive at the fair value. First, let me take you to the 11th rule, 11U. You see, this is the rule. This rule is relevant for valuing as per the requirement of section 11UA. Here it explains what is the meaning of balance sheet. Because here we need to refer to the balance sheet of an entity to arrive at the value, to arrive at the fair market value. Okay. Now, if I take you to the other rules, section rule 11UA, let me directly take you to the rule, rule 11UA. If you search here, determination of fair value, fair market value, you see. Are we able to see it? how valuation of jewelry, valuation of archaeological collections, valuation of shares and securities, which is important for us. Are you seeing? Here you see
Yes.
formula is given, A plus B plus C plus D minus L multiplied with PV divided by PE, where this what is A, what is B, what is C, what is D. This has been described. Okay, so if you are valuing for this purpose, under these premises, so you do not have any option. You have to follow what is prescribed in the statute. Okay, here you see it says the fair value of unquoted equity shares is equal to A minus L divided by PE multiplied with PB, where A is the book value of assets, L is the book value of the liabilities. Okay, and what is P? P is the total amount of paid up equity. Right. So these things, as you see, it has been defined here. PV is the paid up value of such equity shares, and P is the total amount of paid up equity. Are you able to see it?
Yes, sir.
Now it gives us an idea that sometimes statute defines. When statute defines the thing, other rules you can refer to at your free time. So just I wanted to give you some idea that how statute can decide the basis of valuation. Statute can dictate that you have to do valuation in this manner. And what International Valuation Standard says, if you are following that thing, you have to interpret that thing properly. You have to understand what the statute says. You have to interpret. And we'll be learning it how Indian standard says. You'll see also that when you're writing a valuation report, preparing the valuation report, you have to give reference to that statute. Okay, I'll be showing you valuation reports in appropriate time. Now, understood this concept of valuation base.
Yes, sir.
Okay. Now, if you refer to International Valuation Standard, these are the various bases which are discussed of. So there are certain valuation bases which International Valuation Standard itself has defined, like these 6 items you can see: market value, market trend, equitable value, then investment value or worth, then synergistic value, then liquidation value. And also the standard discusses some other values, that other bases of value, like fair value according to International Financial Reporting Standards, then fair market according to as defined by OECD, that is Organization for Economic Cooperation and Development, then fair value as defined by United States Internal Revenue Services, and fair value defined under some other law which are used for legal and statutory purposes. So this list is not exhaustive list. There might be many other valuation bases, but International Valuation Standard discusses about the 6 plus 4, that means 10 valuation bases are discussed there. Got it? Now, let us understand the concept of valuation base by referring to our Indian Valuation Standard, which are issued by Institute of Chartered Accountants of India. And this is about, this valuation standard number is 102 valuation basis. And I am now reproducing para 14 and 14 of Ici Evaluation Standard 102. This standard says that valuation means indication of the type of value being used in an engagement. That means I have to indicate what type of value I am using. Friends, earlier we have discussed in a session about the type of value, what are the possibilities of value, what are the various possible types of value. And valuation means indication of which type of value is to be used. Different valuation bases may lead to different conclusions. If we change the valuation base, then my value may be different. Therefore, it is important for the valuer to identify the basis of value pertinent to the engagement. Which basis of value he is following, that he has to identify. How he can identify? He needs to disclose it in the valuation. And this standard defines the three kinds of valuation base. Can you read these three types? In Indian situation. Can you read it out? A, B, C.
Yes, sir. The first one is fair value, participant specific value, and liquidation value.
Okay. These are the three bases where discussed in this valuation standard. The valuers are select an appropriate valuation base considering the terms and purpose of valuation. Okay, he has to consider valuation terms and engagement and select the appropriate basis. Now, at this stage, if I summarize, I spoke about this valuation basis. So, valuation basis according to International Valuation Standard and valuation basis according to valuation standards issued by Institute of Chartered Accountants of India. So, if you look at this picture, you can find out. So, there are 6 bases which are defined in IVS: market value, market trend, equitable value, investment value, synergy value or synergistic value, then liquidation value, then other valuation base like fair value for legal purposes, fair value as defined by Organization for Economic Cooperative and Development, then fair value as defined by United States Revenue Services. Right? If you come to ICI valuation base, you can find out again valuation value, sorry, fair value, participant specific value, and liquidation value. You can understand that fair value is there both in International Valuation Standard as well as ICI Valuation Standard. Participant specific value, which is there in ICI Valuation Standard, will understand this is something similar to this thing, equitable value. Okay, equitable value as per International Valuation Standard is more or less same as participant specific value. And liquidation value is there in International Valuation Standard. It's also there in ICI Valuation Standard. Got it? Okay. Now, one by one, we're going to discuss about these values so that in appropriate time, you can decide which valuation base to be used to arrive at a value. First, base number 1, that is market value. We are learning it as per IVS, International Valuation Standard. So if you see, it is defined, market value is the estimated amount for which an asset or liability should exchange on valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing, and where the parties had each acted knowledgeably, prudently, and without compulsion. So this expresses what is market value. As you can see, it is various conditions are attached. So market value is the estimated amount. That means when we talk about the market value, so we expect one asset or liability needs to be exchanged on a valuation date. So we arrive at the market value on a particular date. That date is called as our valuation. So on that date, we estimate that the asset or liability needs to be exchanged on that valuation date. And between whom this exchange will happen? And willing buyer, that is no compulsion. Buyer is willing to dispose of the asset. And seller is also willing to acquire that. So between a willing buyer and a willing seller at an arm's length transaction, meaning it is again a fair transaction. The parties are not related to each other. Parties are not influenced by any other thing. There is no other consideration flowing from the parties. So it is called as the arm's length transaction. I think you understand what is the meaning of arm's length transaction. Yes or no? And that too after proper marketing. That means that particular thing, that particular asset or liability must be exposed to market, must be exposed to large number of market participants, buyers and sellers. So after proper marketing, and where parties had been acted knowledgeably, parties are aware, they're knowledgeable, they take prudent decisions and they enter into, or they are expected to enter into this exchange transaction without any compulsion. So on that basis, you have to estimate what is market value. Are you getting me?
Yes, sir.
Okay. So sometimes we need to arrive at the market value. So first, before knowing whether market value needs to be arrived or not, we have to see that this particular base is appropriate to the situation or not. So if a given valuation situation, you decide that market value is appropriate, then you select market value as the base, then arrive at the market. And in this context, when we're talking about the market value, we need to understand this concept also. This is called as HABU, H-A-B-U. HABU stands for highest and best use. That means this, in fact, refers to a valuation premise. This is one of the valuation premise. When I'm referring to the market value of an asset, I am assuming that market value of asset will reflect its highest and best use. Market value might be different from different users. So it is assumed, in these premises, it is assumed that market value of something is there, means it shows the highest and best use. Yes or no? Suppose you are saying the market value of this car is 5 lakh rupees. What it shows? That means the highest and best use of that car is worth 1 lakh, worth this much of rupees. Is it not? Someone may buy that asset and make some alternative use. Okay, somebody may buy that car and open a fast food shop in that car itself. So that is not the highest and best use. If, let us say, someone is looking for a car, who is looking for a van kind of vehicle, which will be using, let us say, for a fast food store, fast food restaurant, or let us say for street, as a street vendor, he will be using it. So then value will be different, but that is not the highest and best use. So here, if we are following this HABU premise, we are assuming that market is reflecting the highest and best use. Are you getting it? This HABU is in fact a valuation premise. We'll be learning about that thing in detail. So the highest and best use is the use of an asset that maximizes its potential, and that is possible, and legally permissible, and financially feasible. If all the three things are there, we can say this is showing the highest and best use value. So asset should be used with maximum potential. It should be possible to use it that manner, and law should also permit that one can use that asset in that manner. And financially also, it is feasible to use that asset. After using us, it should give suitable return, and it is also possible financially to use that asset in that manner. Then only you can say it is the highest and best use. Are you getting? And when I say highest and best use, it may be the continuation of the asset's existing use, or maybe some alternative use. Suppose I am using a car, I want to dispose it off. So the person who is acquiring, he may continue to use the asset for the same use, or it may make some alternative use also. So when you're following market approach, or let us say this thing, market value base, then we have to keep in mind what is the highest and best use of that asset. And when the asset is used with its full potential, in a legal permissible way, and in a financially feasible manner. This is determined, or the HABU premises is determined by the use that the market participant would have in mind for the asset when formulating the price that would be willing to bid. That means when a bidder, or when bidder is giving his quote, then what is in his mind? about the use of that asset. Okay, that will be considered as the highest and best use of that asset. Are you getting this concept of HABU and the concept of market value? So when you are selecting a base as market value base, so you have to justify that this value reflects the highest and the best use of that asset. If uses are different, then value might be different. Are you getting me?
Yes, sir.
This is an example how an asset can be used in different ways, but you have to see what is the highest and best use of that asset. It is situation specific. And when you're learning valuation premises, at that time you'll also understand that when we talk about the concept of value, then we normally refer to non-financial assets, like this which I'm showing you. Financial assets, we need not refer to this value premises when you're valuing some financial assets, like shares, debentures, etc. But for non-financial assets, when you're valuing, we may refer to this value premises. Okay. Now, this is the second base called as market rent. Okay. This is appropriate specifically when a person is having some leasing right kind of thing. So market rate is the estimated amount for which an interest in real property should be leased on valuation date. That means, let us say you have some interest in a real property. Let us say there is a building and you have got a leasehold interest in that property, and you can sublease it, you can lease it out for certain rate, and you want to arrive at the value of that leasehold interest. Then you can use this particular base, market rent base. Right? Okay.
Yes, sir.
So interest in the real property which should be leased out can be in that kind of situation, valuation, this market rent base can be taken. And you have to see the transaction, or you have to visualize the transaction between the willing leaser and the willing lessee on appropriate lease terms in an arm's length transaction after proper marketing, and where parties had been acted knowingly, knowledgeably, prudently, and without compulsion. Okay, so this is called as market rent base. So in a valuation situation, you may use this base because this is also an internationally accepted method, internationally accepted base. But when you can use, when you feel this is there is some interest in a real property and which needs to be valued on a valuation date. So how you can do? You can find out, or you can visualize the transaction between a willing lessor and a willing lessee, and you keep in mind what are the terms and conditions of the lease, and you have to see what kind of cash flow can be generated out of that asset, out of that lease or interest, and that cash flows can be evaluated, and the value of that interest may be arrived at. Okay. This market rent may be used as a basis of value when valuing a lease or an interest created by a lease. So only this kind of situation, this market rent base can be used. So at that time, it is necessary to consider the contract rate, and where it is different, we may consider the market rate. Okay, this is one more base. Right, one is market value, I told you. Second is market rent is one more base. So let us move to the third base. Did you understand the second base?
Yes, sir. Understood.
Yes. So in a given situation, you have to justify which base is more appropriate. Third valuation base is equitable base. Equitable base is the estimated price for transfer of an asset or liability between identified, knowledgeable, and willing parties that reflect the respective interest of those parties. Okay, you see, in a particular transaction, two specific parties might be interested. They might be having some specific interest in that asset or in that liability. So if those interests are reflected in a value, we call them as equitable value. When you say equitable value, this is specific to those parties only. Okay, because here the parties are identified, knowledgeable, and willing parties. Okay, suppose there is a house very adjacent to my house, and I want to acquire that house. For me, that value of house might be more because it is adjacent to my property. Is it not? So the value I arrive, maybe from outsider, value might be less. For me, value might be more. So if I'm selecting that base, I'm arriving at the value which is specific to me, that is called as the equitable value. So the value between the transaction between the seller of that house, the prospective seller, and the prospective acquirer. Are you getting it? So market value might be different from the same house. Market rent value may be different, and equitable value might be different. Equitable value requires the assessment of price that is fair between two specific identified parties. Parties are already identified. Let us say one company is willing to acquire another company for some specific reasons. Then the value may be specific to that, specific to the prospective acquirer. For another company, value might be different. Okay, when you arrive at the specific value, we consider the respective advantages and disadvantages that will be gained from this transaction. Okay, but whereas when we discuss about the market value, the specific advantages and disadvantages are disregarded. Only the advantages and disadvantages which are common or which are available to all market participants, they are considered under market value base. But an equitable value, the specific advantages and disadvantages are considered. Are you getting me?
Yes, sir, understanding.
Okay. Now, next basis is investment value. Investment value is the value of an asset to a particular owner or prospective owner for individual investment or operational objective. So this is again an entity-specific basis of value. Okay, let us say an entity has invested, or one party or a person has invested some money in a company, and he might be getting some return out of this, or he's expecting some return out of this. So what is the value to that particular person? Because for the investor point of view, this is a purely an investment decision. That means he's expecting some kind of returns in future, right? So ideally, if you think in that point of, from his point of view, then the present value of the returns that he's expecting in the future should be the value of that asset, should be the value of that investment. That is called as investment value. Although the value of an asset to owner may be same as the amount that could be realized from its sale to another party, this basis of value reflects the benefits received by an entity from holding the asset and therefore doesn't involve presumed exchange. That means what we are talking about, that if you're holding that asset, what is the benefit you are getting? Let us say you got an asset, you got a building, and you are generating rent out of this. So that is your investment value. In future, you'll be getting rent. Okay, or let us say you have invested in a equity share and you are continuously getting dividend out of this. So these are the benefits you are receiving from holding that asset. right? So you have invested in the asset with expectations of these benefits. So for you, investment value is different. You are not planning to dispose it of. You are planning to dispose it of, value will be different. You may consider market value, but you are not planning to dispose it of. Rather, you are thinking as an investment decision, what is the value of that investment. So the investment value reflects the circumstances and financial objective of the entity for which valuation is being produced. So what is the financial objective of the entity? Entity might be willing to put money as an investment. Okay. So investment value is often computed to evaluate or to measure the investment's performance. Let us say I have invested this much. What is the value as of now? Let us say I have got 5 investments. I can arrive at what is the investment value as of now. So I can say which investment is performing better. Okay, is it clear to you?
Yes, sir, clear.
Now, synergistic value. Synergistic value is the result of combination of 2 or more assets or interests where combined value is more than the sum of separate value. Friends, you are aware of the meaning of synergy. Synergistic value may be different. Okay. So it is the result of combination of 2 or more assets. Right. Let us say there is one company. It is planning to merge with another company. Let us say company A is in electronic media, company B is in the print media. And both the companies wants to merge. They'll become one media house, which will control the electronic media as well as print media. Okay. Now, the value of that company, value of that business, let's say value of that electronic media company will be different. Value of that print media company will be different. But synergistic value will be much more. Are you getting the situation?
Yes, sir.
And if these synergies are only available to one specific buyer, their synergistic value will be different from market value. Okay, market value is what? Market value reflects the advantages and disadvantages which are available to all the buyers, to all the market participants. But synergistic value may reflect to a specific buyer. Suppose I got a media house. I want to acquire another media house. For me, synergistic value will be different. It's not market value because it is specific to me. But for other participants, value might be different. Okay, so when you talk about specific synergistic value, it in fact will reflect the particular attributes of an asset that are only of value to the specific purchaser. If for me it has got some specific use, then it will reflect its value. Okay, the added value, that means company A's value, company B's value, then it's added when it's aggregated. After considering the synergy effect, can be referred to as the synergistic value. It is also referred to as the marriage value. So this is used when you talk about when you evaluate business in the context of mergers, acquisition. Sometimes in demergers also that is relevant. Okay, so this is synergistic value. This is one more valuation base. Next valuation base is about liquidation value. Liquidation value, when you are planning to liquidate your assets, that means you are planning to wind up your company, wind up your business. Liquidation value is the amount that would be realized when asset or group of assets are sold on piecemeal basis. That means you are no more interested to continue your business as a going concern. You want to dispose of your assets. The value will be different. When these assets are used in the business, you are valuing the business. But when you are disposing the asset in piecemeal, then you are not exactly valuing the business. You are valuing those assets individually and aggregating their values. And this liquidation value should take into account the cost of getting the assets into sellable condition. If the asset is not in sellable condition, then you might have to incur some cost to bring it to sellable condition. That cost is to be reduced from the gross value. And liquidation value can be determined under two different premises. Here we are talking about two different valuation premises. One is an orderly transaction with a typical marketing period. You want to dispose of your asset. Suppose disposing of asset requires 10 days or 30 days. Within that days, you are going to dispose of. Or it might be forced transaction with a certain marketing period. That means you have to dispose of as early as possible. Let us say you have to dispose it of in 2 days. Then value will be different. Okay, because the typical marketing period is not there. So if it is a forced transaction, liquidation value will be different. And if it is an orderly transaction, that is not a forced transaction, liquidation value will be different. Okay, and the valuer must disclose the premises of the value assumed. When, let us say, valuer is arriving at the liquidation value, he has to disclose whether he is assuming it is an orderly transaction or he is assuming as a forced transaction. That must be disclosed in the report itself. Understood? The 6 type of valuation basis I told you.
Yes, sir. Understood.
Okay, so friends, again showing you back this picture. So these are the six valuation bases which are defined in the International Valuation Standard. So we need to understand the meaning, because in different contexts we might be using these bases. Right? If you know these bases, then we'll be understanding that which basis will be appropriate. These are already defined. IVS clearly defines the meaning of this thing. What I was showing you exactly, the, you can say, verbatim reproduction of the language which is there in the International Valuation Standard. But the other first valuation basis you are talking about here, fair value legal, these are not defined in the International Valuation Standard, but International Valuation Standard discusses about this. So let us see these 4 types of valuation basis now. Okay, and these are the other bases of value. This is a non-exhaustive list. There might be more values like this. First one is a fair value as defined under IFRS. Friends, you must be aware of what is IFRS. So, as the students of, let us say, finance or financial reporting, you must be knowing that financial statements are prepared by following generally accepted accounting principles. And internationally, these are the accepted accounting principle, that is International Financial Reporting Standards. This standard has to be followed in preparation and presentation of financial statements like balance sheet, statement of profit and loss, cash flows, all this. Okay. So if you refer to IFRS 13, there also there is a definition of fair. And many times that fair value is also adopted as a valuation base. And here what it says, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So this is one kind of base one can take. So accordingly, on the measurement date, here in this context, in the context of valuation, measurement date is the valuation. In the context of financial statement preparation, measurement date may be the balance sheet date. Okay. So on that day, we have to see what is the price that will be received to sell an asset or to be paid to settle an liability, to transfer a liability in an orderly transaction. That will be called the fair value as per IFRS. Okay. Similarly, fair value also been defined in a Model Business Corporation Act. Okay. So this is an American law. In that law also, the concept of fair value has been discussed. According to MBC, the fair value means the value of the corporation's share. Let us say I'm arriving at the company's share, corporation's share. The value of the corporation's share determined immediately before the effectuation of the corporate action. Let us say some corporate action is going to be taken. Let us say a company wants to acquire another company. That's a corporate action. Our company wants to declare dividend. That's a corporate action. Or to declare bonus. That's a corporate action. So the value of the corporate shares immediately before effectuation of the corporate action, before these decisions are made effective. What is the value? That is the fair value. Okay. And how that has to be arrived at? Using customary and current valuation concepts and techniques generally employed in the similar businesses. So what is the current concept, current methods you have to apply to arrive at the value? And that value has to be arrived at without discounting for lack of marketability or minority status. If you're evaluating a share from minority point of view or share which is not marketable. So without discounting that, if you arrive at the value, that will be referred to as the fair value as per MBCA. Okay, but this particular law is specific to United States, but is followed internationally. So on that basis, this base also may be selected to arrive at the business value. This may be also selected as a base. Third is fair value or fair market value as for Organization of Economic Cooperation and Development. This international organization also defines fair value as the price a willing buyer would pay or a willing seller in a transaction in the open market. That means a willing buyer is going to pay a willing seller in an open market transaction. That price will be referred to as your fair value. And this concept of fair value or this base may be used in an engagement when you are valuing for international tax purposes. Fourth value is again a fair value, which is also selected as base in United States tax purposes. Here is also one definition. Fair value is the price at which the property would change hands between a willing buyer and a willing seller, neither being under compulsion to buy or sell, and both having reasonable knowledge of relevant facts. So if you are valuing it for some tax purposes, or you can in any other international valuation situation also, you may refer to fair value as defined in by you can say as referred to in United States Revenue Services assignments. So there you can find this is how it is defined. Fair value is the price at which the property would change hands between a willing buyer and willing seller. So these are the valuation bases we have learned so far as per definition of International Valuation Standard, as explained in International Valuation Standard. Okay, got some idea of this? So depending upon the situation, you may select appropriate base. Okay, but if you want to do a valuation which is international acceptable, you have to stick to these bases only. And coming to Indian valuation standards, as you see, three more bases are there: fair value, participant specific value, and liquidation value. So let me show you that. Ici Evaluation Standard. Here I am referring to valuation standard number 102, which is about valuation basis. Here, Institute of Chartered Accountants of India has made it very clear that the standard does not apply in cases where valuer is required to adopt valuation basis as prescribed by statute or regulation, or in an agreement or arrangement between the parties. That means in this situation, when the law prescribes, then what will happen? These standards will not be applicable. You are not supposed to select these bases. In such case, the prescribed basis shall apply and adequate information should be disclosed appropriately in the report. In that case, the valuation report should clearly show that valuation has been done not as per international acceptable basis, or not as per Indian acceptable basis, but as per the base which is prescribed in the statute and regulations, or as per the agreement and arrangement made between two parties. So this information needs to be disclosed appropriately in the so that the users of the valuation report will understand the valuation basis. Understood?
Yes, sir.
Okay. So in Indian context, I had shown you. Let me share with you some valuation reports. You can see how these things are disclosed. Just a minute. Here I am going to share one valuation report with you. Are you able to see it? No. Now I think you'll be able to see it now, right? Okay.
Yes, sir.
Okay. If you see here, what I wanted to show. Here you see. This is valuation methodology as per Rule 11 UA of income tax rules. This has been disclosed. Okay, how value has been arrived at. The same formula you've seen, which I had shown you earlier. On this, applying this formula, it has been described, it has been interpreted, explained. So on that basis, you see data are collected, and finally, value is arrived at on that basis. Okay, finally, fair market value of unquoted equity shares, you can see A minus L divided by PE multiplied with PB. Okay, so this is A, this is L, this is PE, okay, and this is PB. Okay, PE means paid up equity capital and PB means the paid up value of equity shares. Understood? So what Indian standard says, you have to disclose it in the valuation report, how you have arrived at. Because if you are doing it in a particular premises for a particular purpose, then you cannot adopt any other method. For this purpose, you have to show which is prescribed under statute. Okay, understood? Okay, this is one requirement I showed you as per statute. Then let me share with you one more valuation report. Here I am showing you one more. Here you will also see a kind of disclosure. Here you see how valuation is done in accordance with the FEMA regulation. Okay, this is again a statutory requirement under Foreign Exchange Management Act. You have to see. Here also you have to give disclosure. Okay, here let me show you. Here, if you see purpose of valuation, compliance of the notification number this of Foreign Exchange Management, transfer of issue of securities by a resident person resident outside India regulation. So it is in accordance, in compliance with a particular regulation. So that regulation prescribes some method. That has to be selected as valuation base. So here in the scope and purpose, you have to clearly disclose that what is the purpose, why this valuation has been done, and what is the method. Here it explains, or FEMA regulation explains, if you read it here, how valuation has to be done. Okay, accordingly, valuation has been done. Here it has been arrived at the value. Value per share is arrived at like this. Okay. So the point what I want to focus is that it's not that blindly you will apply a method and arrive at a value. you have to look into the valuation premises. You have to select the appropriate base, which is on that basis you need to arrive at the value, which is appropriate. Okay, and if it is statutorily defined, and you have to follow that base. Okay, friends. Now, let us see some of the bases which are defined in Indian Valuation Standard. Now you see 3 types of value we're talking about. One is fair value. We know that thing. That means price in an orderly transaction. Then participant specific value. Okay, I had told you earlier, what is participant specific value? This is something similar to, you see, equitable value. Here we have seen equitable value and the participant specific. They are more or less same. And fair value also, International Valuation Standard we have seen. This is also more or less same. And liquidation value also we have discussed. 3 things. Okay. So if you are opting Indian Valuation Standard, then you have got these many options. If you are using Indian Valuation Standard, you have to select values based as fair value or participant specific value or liquidation value. Or, you know, the standards are not applicable when the base is prescribed under any statute, rules and regulations. Then you have to follow that base. Okay, friends. Now, fair value means price in an orderly transaction. Participant specific value means specific advantages and disadvantages have to be considered. And liquidation means you are selling an asset in piecemeal basis. Okay, so you're hypothetically closing the business and you're thinking, if I liquidate the business, how much will be the value? That is called a liquidation. First, let us understand. Let us see how it is defined. Fair value is defined in Ici Base 102 valuation basis. Here it says fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants on the valuation day. So if you are selecting the fair value base, you have to see the transaction is orderly transaction and market participants are there. And the value is arrived at the valuation date. Okay. And fair value is the price in an orderly transaction in the principal market. Principal market means market which is most advantageous at the values at the most advantageous market. And we have to refer that value at the valuation date under current market conditions, regardless of whether that price is directly observable or estimated using another valuation techniques. Directly observable means you can observe it from the market. Let us say it is a listed company, you can clearly observe the equity prices. Or let us say it is not observable, then you can estimate that prices by using other valuation techniques are there. Some of the techniques we will be learning. We have also seen some techniques earlier that how you can do relative valuation. You can estimate the value of one company. Accordingly, you can estimate the value of the equities of a company when they're not directly observed. Okay, comparing with the market, we'll be able to estimate that. So that is fair value. What is essential in a fair value is that transaction should be orderly transaction and there should be market participants. And here also we are talking about this HABU concept, highest and best use concept. Okay, and this concept or this premise is used mostly in non-financial asset. This has been clearly defined in Indian Valuation Standard. Okay, highest and best use is the use of a non-financial asset by market participant that would maximize the value of asset or group of assets within which the asset would be used. So it is clear that it is mostly used in non-financial assets. And again, one more you have to see when you are arriving at this HABU premises or we are valuing an asset and we are considering the highest and best use of it. We have to see that use means highest and best use means use of that asset which is physically possible, legally permissible, and financially feasible. Suppose you can use the asset in different ways, but if it is not legally permissible, then that is not the highest and best use. You have to think what is the legally permissible ways of using that asset. And this has to be determined from the perspective of the market participants. Okay. We have to keep in mind that what kind of use that market participants are visualizing or what they are expecting. And this use may be the existing use for which asset is being used, or maybe a different use. It may be new use also. That is called as HABU or highest and best use concept. Then come to the next valuation base, which is participant specific value. Participant specific value is the estimated value of an asset liability considering the specific advantages and disadvantages of either of the owner or acquirer or identified participants. So this is the value which is specific to the participant, specific to the participant to the decision of transfer of this asset. If I consider the specific advantages and disadvantages, then the value I am arriving at is called as participant specific value. And base I am selecting is participant specific value base. Okay, and this value may be measured for an existing owner, for an identified acquirer, or for a transaction between two identified parties, considering the factors which are specific to such parties and which may not be acceptable to the market participants in general. Because these specific advantages and disadvantages may not be available to the general market participants. It may be available to the specific users. Okay, for example, the example I gave earlier, that if there is a house adjacent to my building, I got some specific advantages of acquiring that house. So I may select a valuation base as I may select my valuation base as participant specific. Because in this transaction, the seller and acquirer are participating, there is a specific advantage to that. But it's not available to the general market player. Okay, so market value, those advantages, disadvantages will not be considered. But some specific advantage is there to a specific buyer, identified parties that will be considered under this value base. Participant specific value. Okay, third value is a third valuation base is liquidation value. This this is a value, means the amount that will be realized on sale of an asset or group of an asset when the business is terminated, or you have to contemplate, or you have to assume that business is going to be terminated. If I dispose of these assets, then how much money I will be getting? That is a liquidation value. But here, the value has to be estimated in the premise of an orderly transaction with a typical marketing period, or if it is a forced transaction within a certain marketing period. And this aspect has to be disclosed in the valuation report, that whether it is an orderly transaction or forced transaction, and in which situation this liquidation value is arrived at. Okay, and if some assets are not in selling conditions, then their cost of disposal also needs to be considered while arriving at the value. Okay, understood this valuation basis? So these are the valuation bases we discussed. Okay, the 13 types of valuation bases we discussed, and all these bases are internationally acceptable. And when you are preparing the valuation report, you have to very carefully select that which valuation base is appropriate. And to select that valuation basis, you need to have an understanding about valuation premises. That means under which premises the basis has to be selected is important for us. Valuation premises I'll be covering in a separate class, but right now have some idea that when you talk about the premise of it, I'm referring to what I'm referring to is that how that asset will be used. So people acquire that asset for certain use. Premises of value means assumed use. So if you refer to International Valuation Standard 104, here what is premises value, it has been discussed. Okay. Okay, premises value or assumed use describes the circumstances of how an asset and liability is to be used. And it also says these are the 4 common premises: highest and best use, current use or existing use, orderly liquidation, and forced sale. These are the certain premises which need to be considered. Okay, if you refer to Indian Valuation Standard issued by ICA, so premises of value refers to the conditions and circumstances, how an asset is to be deployed. Here also we are talking about how the asset will be used. Okay, so in some situations, multiple premises can be used to arrive at the value. And these are the list of some common premises of value, which are discussed in the valuation standard. Habu, then going concern value, then as is where is basis value, then orderly liquidation, and forced transaction value. So if you compare between international valuation standard and Indian valuation standard, you can have an idea that these are the premises of value, or this talks about the use or deployment of the asset. And on the basis of these premises, you need to select the valuation base. Are you getting? So a valuer is expected to understand the valuation premises like Habu, current use or existing use, orderly liquidation, forced sale, or going concern value, as is where is value. Okay, so these are the bases he has to consider. On that basis, once he considers the premises or understand the premises, he will be selecting a valuation base. Once valuation base is selected, then he will be able to decide what should be his approach of valuation. Is he going to follow the market approach or income or cost? And in case is following a particular approach, there are various methods are recommended under that approach. Like under market approach, you see market price method, then comparable companies multiple method, comparable transaction multiple methods. Similarly, income approach, DCF method, earning calculation method, dividend discount models, intangible assets separate method we follow. The option pricing models are also followed. Under cost approach, we follow the replacement cost method and reproduction cost method. So these are the methods. So most of the methods will be learning one by one. But I think today we got a fair idea about what are the valuation bases and how that is important. Of course, it is theoretical thing, but I need to have this thing in mind because it is very relevant for us to understand a valuation report and also to prepare a valuation report. Suppose you are reading an international valuation report. So you need to understand under which premises and under which base that value has been arrived at. If I change the premises or change the base, the value might be different. Okay, the same value might give you 2 different values in 2 different situations, meaning in 2 different bases or under 2 different valuation premises. So therefore, sometimes valuer also follow or use multiple bases or multiple approaches also or multiple premises also. That's also possible. Okay. So understanding this basis was important for us in order to select the appropriate method. Okay. Hope you got a fair idea. Is it clear to you, whatever we have discussed today?
Yes, sir.
Yes, sir.
Thank you very much.